Welcome to Markets Now. I'm Michelle Rook along with Rich Nelson of Allendale. A down day in livestock and soybean markets. We were up in corn and wheat futures for the most part. And Rich, we were really dominated in the trade in the commodities today by what was going on with the risk off in the outside markets, weren't we?
No, there's no doubt about that. We've cut 50% off the soybean market rally in recent weeks. We've certainly pushed crude oil to new lows. A lot of risk off trade was certainly the message here in this session. So I think we'll have maybe a separate discussion with tomorrow's focus, especially with a new weather forecast from the government agencies as well.
So what started this was the bank debacle here in the U.S. It is now pushed over into Europe. Is there thoughts that this is starting to mirror 2008, or is there a fear of that at all?
At this point in time, I'm not quite sure if we're near that level of general confusion and general concern. At this point, we're not quite sure what the true foundation level of this is. So I would suggest we have perhaps another 1, 2, maybe 3 days more pressure. Keep in mind, we'll have the Federal Reserve with new numbers out here with interest rates Wednesday of next week. So we'll have to monitor that as well.
Do you think we'll get maybe a pullback in the Fed's aggressive stance here on pumping up interest rates just because of this and the CPI and all of this coming together now?
And that's a really good question. We just might. In fact, some latest updates we saw from Federal Fund futures, roughly half of the traders think that at this point they will not touch interest rates on Wednesday. So we have certainly changed a bit of views right now. The question is whether this is a lasting issue for us in the big picture. So certainly bearish for us right now. We'll see about this in total in the next few weeks.
Yeah, and it did impact money flow in the grain sector today, didn't it?
Boy, it sure did. And you might even argue that some of this was related to the fact that we've just learned that those sharp corn sales from February 21st through 28th on this recent commodity traders update was maybe a little more expected. So some people might suggest that the funds need to cool off, at least for the short term, on the corn side, if nothing else.
Yeah, like 140, 150,000 contracts that the funds liquidated in a 1 week time period now. So do you think that they're flat in this corn market? Does that give them some powder to maybe run this thing up a little bit?
So that's a good question. So as of February 28th, we've had our lowest net long fund position since 2020. So we've removed all those big gains made from early last year. At this point in time, I'm not quite sure if we're relatively even as far as a net fund position. I'd still say they're net long, but certainly this is a very small net long position by recent historical standards. No doubt about it.
Do you think the market reaction was a little disappointing considering we've had all this China business confirmed the last couple days? I mean, it's like over 50 million bushels. That's a big number.
You've got to assume that. And we do have concerns about export sales. Before these China buys, we were still computing anywhere from a 94 million bushel to 194 million bushel shortfall in needed sales. We just taken care of 50 of that. So we should have had some type of more consistent rebound in today's trade for the corn, no doubt.
Absolutely. Wheat market, we've been seeing a couple of up days back to back here now, that market trying to bottom perhaps, but is this just short covering because we're so oversold in that market or not?
I think there's a lot of things going on here for us for the wheat side, and really is not any brand new special perfect news story to give us any bullish hope. What I can say is perhaps maybe this last move down was enough to finally clean out everybody's viewpoint regarding this spring discussion. Keep in mind, it's quite known historically that we do have a sharp spike low in spring prices and then a rebound into harvest. We'll see if that happens this year.
Rich, let's also talk about your Allendale acreage survey that came out. You did find a few surprises in there. Talk about that.
We sure did. So the survey was conducted from the 28th of February through the 11th of March. So this last phase of pricing with new crop corn and soybeans, we certainly thought maybe we'd have a little different shakeout, maybe some smaller corn acres instead of the plus 1.8 that the survey suggested. And we expected a little more soybean acres. The survey only suggested 300,000 extra. So that's certainly one question still in play with this spring planting.
And you actually saw a decrease in spring wheat and durum acres, whereas USDA actually increased those in the latest Ag Outlook Forum, right?
That is right. So our survey, at least for this portion of the discussion, was still consistent. Lower spring wheat acres, Keep in mind, USDA's Ag Forum, like you mentioned, did suggest a small increase, which was a surprise to a lot of us. So we'll see if that does hold out. Main message we're still getting from North Dakota producers is, for now, they want more corn and less wheat.
Yeah. The main theme across the whole acreage survey, though, is that production is going to be increasing here in 2023, right?
It sure is. And we do have a small concern, obviously, with this North Dakota planting situation, especially for corn. And of course, we'll have a discussion maybe with government agency updates here directly ahead with summer weather forecast. So as of this time, the government has not joined the private forecasters in suggesting a small amount of concern for summer. So that'll be another factor to play out ahead.
All right, we'll see how that plays out at the end of the month. Livestock futures, 2 down days in a row here. Clearly, we're getting caught up in the macroeconomic concerns there on both cattle and hogs, right?
We certainly can. And you can argue that the cattle side was moderately reasonable. I mean, we had some chart stuff pointing head and shoulders top on the June live cattle. That gave us 156.42, and we hit that today perfect, no problem. I was quite surprised at this near $4 break for summer hogs. We admit that, yes, cash hogs are low, Chinese hog prices are going nowhere. We admit that fully. But this almost $4 break in summer futures maybe a bit too much too fast here for hogs.
Right. And no trend change yet in the live cattle. And in fact, do you think we'll find support here just because we're going into a cattle on feed report on Friday?
Yeah, I would suggest maybe some stability. So let's have maybe perhaps one more spike day down in this cattle market real quick, clean out some people as far as this bearish sentiment. But realistically, these are still now considered slightly undervalued prices in our viewpoint for this movement into Q2.
Plus, we had a little disappointment. I think we had some cash trade at 164 today, so that was maybe a little bit under expectations, don't you think?
Certainly right. And keep in mind, we can agree with a little bear trade in the short term. Wholesale beef has topped. We're about $5 off that recent peak. Wholesale beef buyers have really been stepping away from doing long-term procurement. So we can agree with lower prices. This level of low price is probably where we're going to draw the line as far as what's reasonable and what's not.
Okay, let's hope we get a rebound. Thanks so much for joining us, Rich Nelson with Allendale, and that is Markets Now.